Welcome to the Deep Dive. Today, we're going to be taking a deep dive into value investment philosophy. You've given us some really interesting stuff to look at, including excerpts from Seth Klarman's Margin of Safety.
Yeah, Klarman's book is it's a classic for a reason.
So let's get right into it.
He really lays out the core principles of this whole approach to investing and shows how it can really lead to long-term success.
Okay, so let's start with the basics then. What exactly is value investing? It seems like everyone throws that term around, but what does it actually mean in practice?
I think of it this way.
Yeah.
Value investing is kind of like being a detective,
Right.
searching for clues that reveal a company's true worth. It's about looking beyond the hype and really digging into the fundamentals of a business to see if the market price actually matches its intrinsic value.
So it's not about like chasing the latest hot stock or trying to time the market or
Right, not at all. It's about finding those often overlooked or misunderstood companies where the market price doesn't reflect the real value of the underlying business.
I see Klarman makes a really big distinction between investors and speculators.
Right.
Why does he think that's so important?
He uses this really vivid analogy of trading sardines.
Okay.
Imagine buying a can of sardines not to eat them, but just to sell them at a higher price to someone else.
Yeah.
You're not really focused on the actual value of the sardines at all.
Right.
You're just hoping someone else will be willing to pay more for them.
Got it.
That's speculation.
Okay, so speculators are focused on like those short-term price movements.
Right.
While investors are more focused on the long-term value of whatever assets they own.
Exactly. And that's really where the concept of cash flow comes in.
Okay.
Investors want to own assets that actually generate cash over time, whether it's a business that produces goods or a rental property that brings in rent or a bond that pays interest.
That makes sense. Speaking of knowing what an asset is actually worth, Klarman talks a lot about the importance of a margin of safety.
Right.
What exactly does that mean? And why is it so crucial for value investors?
The margin of safety is kind of like having a built-in cushion for your investment.
Okay.
It's that difference between the price you pay for an asset and what you estimate to be its intrinsic value. The bigger that gap, the more protection you have.
So even if you make a mistake in your analysis or, the market throws you a curveball,
Right.
that margin of safety helps to limit how much you can lose.
That's the idea. It protects you from the unknowns and the inevitable mistakes we all make as investors.
But figuring out the intrinsic value of a business sounds pretty tricky.
It is.
How do value investors actually go about doing that?
Yeah, there's no magic formula or one-size-fits-all approach here.
Right.
It's more of an art than a science.
So it's not as simple as just looking up a company's stock price.
Yeah. No, it requires digging into those financial statements, analyzing industry trends, making judgments about a company's competitive position and future prospects. It's like piecing together a puzzle.
Yeah.
Using all the information you can gather to form a well-informed estimate.
And Klarman even talks about how things like inflation, interest rates, even market sentiment can impact a company's value. It seems like a lot to keep track of.
It is, and that's why that margin of safety is so important. It recognizes that our valuations will never be perfect.
Right.
It's about accounting for that uncertainty.
So you're acknowledging that there's always a degree of guesswork involved.
Sure.
But you're trying to tilt the odds in your favor by buying with a margin of safety.
Exactly. It's about managing risk intelligently and recognizing that we can't predict the future with certainty.
Okay, let's dive into some specific valuation methods. You mentioned net present value, private market value, and liquidation value. What are those all about?
These are all different tools that value investors can use to try to estimate a company's worth. Net present value, or NPV, is all about looking at a company's future cash flows. It's essentially a financial time machine that lets you bring those future earnings back to the present and compare them to the current market price.
So you're projecting a company's future earnings and then discounting them back to today's dollars.
Right.
To see if the stock is actually a bargain.
That's the gist of it.
Cool.
It's particularly useful for companies with predictable cash flows, like those in stable industries with a long track record.
Okay, what about private market value? How does that come into play?
Private market value looks at what similar businesses have sold for in recent transactions. It's like checking those real estate listings to see what comparable homes in your area have sold for.
I see.
It gives you a sense of what the market might be willing to pay for a particular type of asset.
So you're using real-world transactions as a benchmark for what a company might be worth in a potential acquisition scenario.
Exactly. It's a useful data point, But it's important to remember that private market values can be influenced by a lot of factors, so it's not always a perfect indicator.
Okay, makes sense.
Uh.
What about liquidation value? That one sounds a bit more dramatic.
Liquidation value is kind of a worst-case scenario.
Okay.
It's essentially asking, what would we get if we had to sell off all of the company's assets piece by piece?
Okay.
It's not always the most accurate reflection of a thriving business, but it does provide a floor for what the assets might be worth.
So it's sort of a break glass in case of emergency valuation method.
That's a good way to think about it. It's especially useful when analyzing companies with a lot of tangible assets like real estate or equipment.
Klarman spends a lot of time talking about where value investors find the best opportunities.
Right.
Are there certain areas of the market where these kind of hidden gems tend to pop up more often?
Absolutely. Value investors are always on the lookout for situations where the market might be mispricing assets. One area that Klarman highlights is spin-offs.
Spin-offs?
These are when a company separates a division or subsidiary into a new independent company.
Okay. Why would that create an opportunity for value investors?
Sometimes the market doesn't fully appreciate the value of that spun-off company.
I see.
It's like the parent company is selling a valuable asset at a discount because investors just aren't paying attention.
So it's like finding a hidden treasure in plain sight.
That's a great analogy. The value is there, but it might take some digging to uncover it. Another area is thrift conversions.
Thrift conversions.
These are a bit more specialized, but essentially it's when a mutually owned savings and loan association converts to a publicly traded company.
I've never even heard of that. Why would that be an opportunity for value investors?
What's interesting is that during these conversions, new shares are often offered at prices that are significantly below their true value.
Wow.
It's because the market for these types of stocks can be really inefficient.
Okay.
And investors might not fully understand the underlying worth of the newly converted company.
So it's another situation where a lack of market understanding can create a price discrepancy that savvy investors can exploit.
Precisely. It's like having a bit of insider information, even though it's all publicly available.
But finding these undervalued assets is only part of the equation.
Right.
You also need to have a reason to believe that the market will eventually recognize that value.
Right.
That brings us to the idea of catalysts. What are catalysts, and why are they so important in value investing?
Catalysts are those events or actions that can help close the gap between a company's market price and its intrinsic value.
Okay.
They're like sparks that ignite a price correction, bringing the market price closer to what the business is truly worth.
So they're kind of like the missing piece of the puzzle.
Mm-hmm.
You might find a company that seems undervalued, but without a catalyst, it could stay that way for a long time.
Exactly. Value investors are always looking for those situations where there's a clear path to realizing the value they see in a company. They want to make sure there's a reason to believe that the market will eventually catch up.
Can you give us some examples of what those catalysts might look like?
Sure. A classic example is a company being acquired by another company at a premium to its current market price.
Okay.
That's a pretty clear signal that the market was undervaluing the business. Other catalysts might include things like a company spinning off a valuable subsidiary, a company buying back its own shares, or even just a significant improvement in the company's operating performance.
So you're looking for signs that the company is taking steps to unlock that hidden value, or that the market is starting to recognize the company's true potential.
That's the idea. It's about finding those situations where there's a good reason to believe that the market will eventually come around to your point of view.
But if these opportunities are out there,
Yeah.
why doesn't everyone just jump on them? There must be some challenges to finding these undervalued assets and waiting for the right moment to invest.
You're right. It's not always easy.
Yeah.
One challenge is that the market can be irrational for long periods.
Yeah.
Even when you've identified a clear bargain, it can take time for the market to catch up and reprice the asset accordingly.
So patience is key.
Absolutely. It's about having the discipline to stick to your strategy even when the market seems to be ignoring your analysis.
Klarman also takes issue with the efficient market hypothesis.
Right.
That's the idea that stock prices always reflect all available information.
Yeah.
Why do you think he disagrees with that theory?
Klarman argues that the market is far from perfectly efficient. There are often discrepancies between a company's true worth and its market price due to things like investor psychology, market trends, and temporary imbalances between supply and demand.
He uses the example of the Spain fund frenzy, where investors bid up the price of this closed-end fund to more than double its actual value.
Right.
That sounds like a clear case of the market getting things wrong.
It is, and it highlights the fact that emotions and speculation can sometimes drive prices far away from rational valuations. Value investors see those moments of irrationality as opportunities.
Another example he uses is the rise and fall of junk bonds in the 1980s.
Right.
How does that story illustrate the dangers of relying solely on market prices as indicators of value?
The junk bond market in the 1980s got caught up in a lot of hype and loose lending standards.
Yeah.
Investors were focused on the potential for high returns, but ignored the underlying risks. When the market turned, many of those junk bonds defaulted, leading to massive losses.
So it seems like that story is a cautionary tale about the importance of looking beyond market sentiment and really digging into the fundamentals of a business.
Exactly. It's a reminder that market prices can be misleading, and it's crucial for investors to do their own research and develop their own independent assessment of value.
So far, we've talked a lot about the theory behind value investing, but I'm curious to see how it actually plays out in practice. Can you give us a concrete example of how value investors have applied these principles in the real world?
Sure. Klarman provides several fascinating case studies in his book.
Okay.
One that stands out is the story of the City Investing Liquidating Trust. It's a great example of how a complex situation, often overlooked by most investors, created a lucrative opportunity for those willing to dig a little deeper.
All right, let's break down this case study. What happened with the City Investing Liquidating Trust? And how did value investors capitalize on this situation?
City Investing was this conglomerate that went through a series of divestitures and restructurings back in the 1980s.
Okay.
As part of this process, they created a liquidating trust to sell off the remaining assets.
Okay, why would that be of interest to value investors?
Well, many investors saw this as a messy and uncertain situation.
Okay.
And quickly dumped their shares in the trust.
So the market sentiment was negative,
Right.
and investors were essentially selling these assets for less than they are worth.
Exactly. But value investors saw an opportunity. They recognized that the trust's assets, which included things like real estate and private equity investments, were likely worth significantly more than the market price of the trust units.
So they were essentially buying $1 for 50 cents, just like that classic value investing principle.
Precisely. And because the trust was in the process of liquidating, there was a clear catalyst for realizing that underlying value.
Oh,
As the trust sold off its assets, it distributed the proceeds to the unit holders, generating substantial returns for those who had bought in at a discount.
that's a great example of how value investing can play out in practice.
Yeah.
It highlights the importance of patience, independent thinking, and the ability to see value where others might not.
It does. The City Investing case is a great reminder that the best investment opportunities often lie outside the mainstream in those overlooked or misunderstood corners of the market.
We've covered a lot of ground in this first part of our deep dive.
We have.
But before we move on, can you summarize some of the key takeaways so far?
Absolutely. First and foremost, value investing is about buying assets for less than they're worth.
Okay.
This requires a focus on intrinsic value, not just market noise.
Right.
Second, embrace a margin of safety. It's your protection against the unknown and a key element of intelligent investing. And third, be patient and disciplined. It takes time for the market to recognize value, and it's essential to resist the temptation to chase short-term gains.
Those are excellent points. And always remember, it's a marathon, not a sprint.
Precisely. Value investing is a long-term game that rewards those who can think independently, analyze businesses thoroughly, and act with patience and conviction.
We'll pick up our exploration of value investing in the next part of our deep dive. Stay tuned.
So now that we've got a pretty solid understanding of the core principles of value investing, let's think about how we can apply this approach to different types of assets and different market situations.
I'm ready to put this knowledge into practice.
Yeah, right.
What specific areas of the market should value investors be paying attention to?
One area that Klarman highlights is, distressed or bankrupt companies.
Okay.
These situations can be quite complex.
Yeah.
But they often offer compelling opportunities.
Distressed and bankrupt companies sound risky. Why would a value investor want to get involved with those?
Well, it's true. These situations come with added risks.
Right.
Remember, higher risk often translates to potentially higher rewards because these companies are facing difficulties.
Right.
The market tends to overreact and push prices down, further than is really warranted.
So you're saying that the market's fear can create opportunities for value investors to buy assets at a significant discount to their intrinsic worth.
That's the idea. It's about looking for situations where The market has mispriced the assets due to negative sentiment.
Okay.
However, it's not just about buying cheap.
Right.
It's about buying cheap and really understanding why the company is in distress in the first place.
That makes sense. How do you determine if a distressed company is actually worth investing in?
You need to carefully analyze the reasons behind the company's distress.
Okay.
Is it facing temporary challenges like an industry downturn or one-time event?
Okay.
Or are there deeper structural problems with the business?
So you're trying to separate the companies facing temporary headwinds
Right.
from those that might be fundamentally flawed.
Exactly. If the underlying business is fundamentally sound
Right.
and the distress is primarily due to manageable factors,
Okay.
there's a good chance the company can recover and generate substantial returns for investors who buy in at a depressed price.
And what role do catalysts play in these situations? We talked about those a bit earlier.
Oh, yeah. Catalysts are absolutely crucial in distressed or bankrupt situations.
Okay.
You need to identify those potential events or actions that will help unlock the hidden value you see in the company
Okay.
and signal to the market that you know its prospects are improving.
Could you give us some specific examples of catalysts in these scenarios?
Certainly. A catalyst could be a successful debt restructuring that reduces the company's financial burden,
Okay.
a divestiture of non-core assets that brings in much-needed cash,
Okay.
or a turnaround in the company's operating performance that demonstrates its underlying strength.
So you're looking for signs that the company is taking concrete steps to address its problems and improve its financial health.
Yes. Without a catalyst, it's possible for a company to remain undervalued for a long time,
Right.
even if its fundamentals are improving.
Okay.
Value investors seek those situations where there's a clear path to realizing the value they see.
Right.
It's about having a reasonable expectation that the market will eventually recognize the company's true worth.
Okay, we've been talking a lot about market downturns in distressed companies.
Right.
Does value investing perform particularly well in down markets?
Actually, yes.
Okay.
Value investing's focus on downside protection and margin of safety truly shines when markets take a dip.
Yeah.
You know, when fear takes over and investors panic.
Right.
Prices can drop significantly often below a company's intrinsic value.
So it's like the market is having a fire sale,
Yeah.
and value investors are there ready to scoop up bargains, while everyone else is running for the exits.
That's a great analogy. The margin of safety provides a cushion,
Right.
protecting value investors from the worst of the downturn because
Yeah.
they've bought in at a discount.
Right.
They have less to lose if prices continue to fall.
Klarman also discusses portfolio management and trading.
Yeah.
How do these concepts fit into the value investing framework?
Portfolio management is crucial for any investor,
Yeah.
but it's particularly important for value investors.
Okay.
Since they often hold concentrated positions in undervalued assets,
Right.
they need to manage risk carefully and avoid excessive exposure to any single investment.
So diversification is still important.
Yes.
Even though value investors might have strong convictions about their individual holdings.
Absolutely. Diversification spreads risk and reduces the impact if one investment goes south.
Right.
However, value investors typically take a more focused approach to diversification,
Okay.
preferring to own a smaller number of companies that they understand deeply,
Yeah,
rather than spreading their investments too thin.
that makes sense. It's about quality over quantity.
Oh,
What about trading? It seems like value investors with their long-term focus wouldn't be doing a lot of buying and selling.
you're right. Value investors aren't day traders.
Okay.
They're not concerned with short-term price fluctuations.
Right.
However, they're not completely passive either.
Okay.
There are times when it makes sense to adjust a portfolio based on changes in valuation,
All right.
the emergence of new opportunities,
Yeah.
or shifts in the overall investment landscape.
So it's about being opportunistic and responsive to changing circumstances while staying true to the principles of value investing.
Precisely. Value investors continuously reassess their holdings.
Okay.
They look for situations where the margin of safety has eroded,
Okay.
a better opportunity has presented itself,
Right.
or their original investment thesis is no longer valid.
This has been a fascinating exploration of the practical aspects of value investing.
Yeah.
I'm starting to see how these principles can be applied in various market situations
Right.
and for different investor profiles.
It's all about adapting the core principles to fit your circumstances and risk tolerance.
Right.
Remember, value investing is a journey, not a destination.
Okay.
It requires continuous learning, adaptation, and a commitment to the long game.
In the final part of our deep dive,
Okay.
we'll look at how value investing can help us navigate today's ever-changing market landscape.
Right.
And explore some key takeaways for putting this philosophy into practice. It seems like value investing, with its focus on long-term thinking and fundamental analysis,
Right.
offers a valuable compass, I think, for navigating today's market,
Yeah.
which just seems to be driven by so much short-term noise and speculation.
You're absolutely right. The principles of value investing are timeless,
Okay.
and they hold true regardless of the market environment. In fact, they become even more crucial
Okay.
during times of heightened uncertainty or volatility.
We've seen some really wild swings in the market lately.
Yeah.
Fueled by, everything from geopolitical tensions to rapid technological advancements
Right.
to concerns about inflation. It can feel really overwhelming trying to make sense of it all.
It's undoubtedly a challenging landscape, but that's where the discipline and the focus of value investing
Yeah.
truly shine.
Okay.
Instead of getting caught up in the emotional roller coaster of the market, you can concentrate on what's within your control. Identifying high-quality businesses, understanding their intrinsic value, and seizing opportunities to buy when they're trading at a discount.
So it's about tuning out the noise and sticking to your process,
Yes.
staying focused on the fundamentals.
Precisely. Value investing is about maintaining a long-term perspective and not letting those short-term fluctuations dictate your investment decisions.
And it's also about recognizing that the market doesn't always get it right.
Right.
Prices can sometimes be significantly out of sync with the company's true worth.
That's a key insight. The market isn't always rational. Emotion, speculation, even simple misunderstandings can cause prices to deviate from that fundamental value.
Right.
These moments of irrationality are where value investors find their edge.
One question I keep coming back to is, knowing when to sell.
Right.
It seems like finding those undervalued assets is only half the battle.
Yeah.
Knowing when to take profits or cut your losses seems just as crucial.
That's a great point and a question every investor wrestles with.
Yeah.
For value investors, the decision to sell often hinges on a few key factors.
Okay.
One is when the price of an asset has climbed to a point where it no longer represents a good bargain relative to its estimated intrinsic value.
So when that margin of safety we discussed earlier has shrunk,
Right.
it might be time to think about taking some profits off the table.
Exactly. Another factor might be the emergence of a more appealing opportunity.
Okay.
If you found a more compelling investment with a wider margin of safety
Yeah.
or greater potential for return, it might make sense to shift capital from your current holdings.
Makes sense. So it sounds like portfolio management for value investors
Right.
is an ongoing process,
It is.
constantly evaluating your holdings and looking for ways to optimize returns while managing risk.
That's exactly right. It's about being adaptable
Okay.
and responding to changing market dynamics and new information
Yeah.
while always remaining grounded in those principles of value investing.
As we wrap up our deep dive into value investing,
Okay.
are there any final pearls of wisdom or key takeaways you want to leave our listeners with?
I'd emphasize that value investing is more than just a set of techniques or strategies.
Okay.
It's really a philosophy, a way of thinking about the market that emphasizes patience, discipline, and a focus on long-term value creation.
Okay.
It's not about getting rich quickly,
Yeah.
but it's a proven approach that can help you build wealth and navigate the complexities of financial markets with greater confidence.
This has been an incredibly insightful exploration of the world of value investing.
It has.
I feel like I've gained a much deeper understanding of the principles,
Good.
the challenges, and the potential rewards of this approach.
Right.
So remember the key takeaways: focus on intrinsic value, not market noise. Embrace that margin of safety, be patient and disciplined, and never stop learning. Who knows what amazing investment opportunities might be hiding in plain sight, just waiting for a value investor like you to discover them. Happy investing.